anywhere close to 10,000 or even 9,500 in March. Mahesh Patil joins us now, represents Birla Sun Life AMC. Mahesh, good to have you back. Thank you for joining us. Hope all's well with you, your family and your daughters are doing fine.
Yeah, good morning, Nico. Yeah, all fine at our end here.
All good to hear that. Mahesh, how are you making sense in this market which everybody is saying is going mad? Largely because of liquidity. There is so much of money which has been thrown around suddenly that everybody is chasing stocks at ridiculous levels.
Yeah, I mean, there's no doubt that there is enough liquidity awash globally and in India. And also the support which has been given by the various government in terms of large fiscal stimulus. So a concoction of monetary and fiscal stimulus has led to the sharp rally in the market. But also that what it means is that the recovery, what you will see because of the impact damage because of the pandemic, also the recovery will be much faster. That's what the hopes are building up. And that's what the market is looking beyond the next couple of quarters and looking into the next year is starting to factoring at this point in time. So I would say that, yeah, I mean, from a very near-term perspective, the markets looks to be fairly priced at this point in time. But I think if really one takes a longer-term view, say next 3-year view, and if you assume that in FY23, also the market or the economy comes back to its normal growth rate, right, trajectory, what it would have been otherwise. And if you take that period and try to look at what the market would do if it discounts that, then the market even from these levels looks very attractive, right? I mean, arguably on a P multiple, it might look very expensive because the earnings are depressed. But on price to book value and other valuation parameters, it is still below the long-term average. So as those things being revert back in the next years, I think the market can still deliver returns from here, which is at least in line with its long-term average is what we would presume. So I'm not too worried. I think for investors who are coming even at these levels, I think they would still make good returns from a longer-term perspective. But from near-term, we have to be a bit cautious because any risk, anything in domestically or globally can lead to some correction from here.
Mahesh, what do you make of the initial set of numbers which have come out? The surprise has come from, let's say, in SBI cards, even for that matter, Infosys. I looked at the numbers which came from Britannia. Sectors where we know there was a problem because of global disruption, local demand, all of them have made a comeback. Something like SBI cards, good guidance. HDFC Bank growing. Infosys, they've given a decent guidance. Where has so much of growth come in from? Because the economy has not recovered both locally and globally, but individual companies are ready to perhaps stick the neck out and talk about a brighter future and a rosy curve ahead.
So that's a very good question. So I think there are two things which are happening. Clearly within certain sectors, okay, we've seen that the impact has not been that great. In fact, actually it's helped the pandemic. So we talked about the FMCG sector. So in that, Britannia, for example, in the foods category, we've seen that the growth has actually been for the industry has been higher because people are looking for packaged foods, biscuits in an effort where other things are not available easily. So that's helped over there. But in other sectors, like in the banking sector or other sectors, what we've seen is that the better companies over there who have been having a stronger balance sheet and good risk management have been able to gain market share. So the growth, what we're seeing for, say, HDFC Bank or SBI cards relatively is the fact that they have gained market share from the other players. And that's what is reflected. And many companies, I think while the top line growth is still lower than what one would have expected, but the EBITDA growth has been fairly, where the surprise has been positively because I think many companies have seen that there are a lot of cost levers which they have used during this period to drive profitability. So the EBITDA growth surprise is pretty much there. We've seen that recently in the cement companies also where the EBITDA per ton has actually gone up even as volumes are down around 30% or so. So that is something which is adding to the bottom line. And the numbers are not looking as bad as one would have expected if the operating deleverage would have played out fully.
Mahesh, suddenly there is a big re-rating which has come amongst a lot of PSU stocks, a BHEL, a SAIL. Is there reason to believe that now some of the PSU stocks may start occupying center stage once again, because some of these stocks are trading way below the intrinsic value? The corporate tax rate also will benefit them. The stocks are so cheap that they just cannot fall anymore.
There's no doubt that some of the PSU stocks are a deep value in the sense they have underperformed even in this rally, and even they underperformed before the COVID crisis. And a lot of these companies are offering a good payout ratio. The government has increased the payout mandatory at least 30 to 40%. Dividend yield is good. But some of these companies lack the growth figure, and that's why there were not much interest over there. So I think in some of the cases, like in defense, we've seen activity because there is the increased level of spending which is expected over there. We've seen some rally in the defense stocks. But otherwise, I think there's not much. I think there's talk about some amount of privatization, okay, some more strategic sale, okay, of the PSUs, which is likely to happen, which can rate a few companies. If one company in that sector gets re-rated, the others could follow. So if you're able to, government is able to demonstrate that in the next, during this year, I think you could see some potential for re-rating. Obviously, that process has got slightly delayed because of the COVID crisis, but I think government is firmly looking at least presenting some cases, showcases at least in this fiscal year. So I would say that in an environment now where interest rates have come down, okay, it's now at around 5% bank fixed deposit. Some of these PSUs which are offering good earnings yield and dividend yield, which is in excess of that, offer a good margin of safety over here. And as the economy recovers, I think most of these PSUs are also linked to the economic growth. There are core sectors of the economy in the oil and gas sector, for example, in the utility space, in the metal space. You should see some of these stocks start to play out. I mean, obviously they are laggards, and they will probably catch up in the latter part of the market rally. We've seen first the frontline stocks move up, then the quality mid caps. I think the PSU banks or the PSU stocks in general should see rally as the broader market starts to go up.
Sure. Mahesh, morning. We've been seeing as to how heightened the retail participation of late has been. I mean, call it whatever, fear of missing out feeling or whatever have you. But tell me, what's been the nature of the lumpy money and the HNI flows into your mutual fund schemes? And did they buy into the markets in the dip in March, April itself, or they continue to pour into the MF schemes in sizable chunks?
I think you are right. I think we've seen a good amount of retail participation into the market, and that's been reflected in the percentage of retail volume as a percentage of total volume, which is at record high levels. So, so I think a lot of money is directly getting into the market. I think individual investors, people are having time at hand, so dabbling into the markets probably. But on the mutual fund side, inflows, we have seen that last month was tepid. It was more or less flattish. This month also, the run rate looks like it will be similar to what we saw in the previous month. Initially, I think when the market corrected sharply in the month of March, April, and May to some extent, we saw money come in. Okay, there were attractive levels, and a lot of money moved into the mutual fund. But subsequently, I think at the market rally, we've seen that there are the institutional money into the mutual fund, or the HNI money has seen some amount of redemptions, some profit taking at the higher levels. The actual retail money in terms of which is SIP, that has remained fairly steady, though that has also seen a marginal dip, but nothing significant to be alarmed about. So net, I would say the mutual fund flows are still tepid. They have not seen much increase even in this month. But I think money is getting diverted, retail money directly into the markets, and that's what we're seeing in terms of the retail volumes go up.
In your own mutual fund schemes, though, Mahesh, what is it that you're advising your customers? Are they safer sticking by with the large caps, or do you think for the longer term, say the next 2 to 3 or 5 years even perhaps, there could be higher beta generation in small and mid cap funds in particular because they've been, way more beaten down than the large caps?
So yeah, I think in that aspect, I think clearly, I think the large cap companies in this kind of an environment offer a lot of safety. We are also seeing a broader theme which is playing out where the big is becoming bigger, right? It had started off after the GST and the demonetization, but subsequently, I think after the COVID crisis, we've seen that also coming, getting further accentuated. So the large cap companies continue to provide that stability, and they will also gain market share and do well. Having said that, the mid and small cap space has underperformed quite a bit in the last 2 years, and the valuations there are looking fairly decent. In fact, relative performance of the mid cap and the small cap index vis-a-vis the Nifty is at a kind of an 8 to 10 year low. So we are seeing a value in the mid and small cap space, but obviously the risk in the small cap space is also higher because of the crisis and the slowdown of the economy. You will see a lot of companies in the small cap sector or in the mid cap sector would face a lot of challenges. Companies which have got leverage would find difficulty, and many companies would probably not be able to survive. So one has to be careful over there. But clearly, if I take a 3-year view from here, we are seeing a good value in decent quality mid caps. And as such, we are agnostic toward market capitalization at this point in time. We are looking at bottom up. And in our portfolio also, we are looking at more bottom up, not necessarily trying to build exposure either in large caps or mid caps, largely agnostic. And to that extent, we are advising investors to really put money large into a multi-cap fund where they can play across the market capitalization spectrum.
Sure. Mahesh, let me get your view as well on some of the pockets that are starting to emerge as prospective leaders. Now we've got the move on IT, and clearly that's one segment that seems to have better visibility and has been very confident of deal flow as well, picking up, and has adapted to the current situation fairly quickly. And kind of adjacent to that, but for, of course, a whole lot of other reasons, telecom as well, being one that's slightly more resilient in the current crisis, but then, of course, having its own challenges with the ongoing AGR issue, for example, and other cost pressures. Just want to get your sense in terms of really where some of the other opportunities and prospective leadership may come from, as IT for sure is definitely being talked about. Bharti has made a huge comeback as well. Vodafone Idea looks like possibly it may also be a dark horse.
So within the, I think, IT sector and telecom, I think clearly IT has surprised in terms of the recovery what it is showing, at least in the coming quarters as per the guidance. Because last time in the global financial crisis, we've seen that the impact was much bigger. And that's what one was anticipating. But it seems that the move toward digitization and moving towards IT is actually benefiting the sector as companies are investing more into IT going forward out of this crisis. So in that sense, we are seeing that the IT companies are not seeing as much impact. The downgrades to earning is not. In fact, we're seeing some upgrades after this quarter. And that's, I think, both. Well, the sector looks fairly defensive in that sense. We've seen some amount of re-rating in the sector because globally, we're seeing the companies listed on the NASDAQ in the IT sector. The comparable peers have also seen multiples getting re-rated. But I think overall growth in the sector would still remain tepid. I think it's probably high single digits. But the sector offers more stability and visibility from long-term perspective and generates good cash flow. and that's why it will continue to do reasonably okay, I would say. And on the telecom side, again, been fairly decent sector, which has not been impacted much. Though this quarter, we might see a slight tepid decline quarter on quarter because of the migrant labours and other things. We've seen some disruption over there. But by and large, I think as the usage of data, we've seen that explode, especially during this COVID crisis, and I think that trend will continue. So longer term, we see a decent scope for margin ARPU improvement, which will continue to drive top line as well as bottom line growth for the telecom players. So yeah, these sectors look steady. I think they are looking more of defensives and a steady growth in the coming years is what one can expect from these two sectors.
Sure. Okay, so that's the view coming in there as well. From the kind of commentary that we've seen so far as well, Mahesh, I know you said that you're not too concerned at the moment about those long-term risks. For now, there seems to be enough liquidity firing away. In terms of commentary that's come in so far, post earnings, when it comes to the financial names on the back of the likelihood of any NPA risk or financial downside, post the pandemic, again, seems to be well contained, seems to be limited. Are you anticipating further moves on the monetary side in terms of policy, anything else in terms of stimulus that may actually fire away some of these segments of the market?
Yeah, so the banking and financial services sector is a sector which is still a laggard, I would say, in terms of the overall recovery, what we've seen in the market. And there is some amount of stress and pain which is likely to play out in the sector. But I think, again, the initial feedback and results which are coming in suggest that the moratorium which some of these companies had, people are aware, around 2 months back, that number is now coming down. So the impact is not as big as what one would have expected, especially on the retail side. And that is encouraging. And while we will not know exactly how much the loss would be in terms of actual NPAs getting because of the moratorium, which we'll only get to know the exact nature of that somewhere in the fourth quarter of this fiscal year. But I think overall the sector is kind of coming back fairly okay. The liquidity is also improving, especially for the NBFC sector. We've seen that in the last month or so, because of heightened liquidity, the yield, the borrowing rate for the AA and below NBFCs, that has come down, right? So the yields which had widened significantly for AA and below NBFCs, that is coming down, which is a good sign. So the money is moving over there, and that will provide some relief to the NBFC sector. Having said that, within the sector, I think you will see that many of these companies, especially the NBFC sector, will still continue to struggle on the liability side, and would see probably slow down or unwind of the book. And but the better names over there, I think, will gain market share and come out much stronger after this crisis. So I think this sector still offers decent value at this point in time, and the way the outlook is looking now on the economy front, I think we're not looking as depressed, at least in terms of the outlook from a medium-term perspective. I would say the sector offers good value at this point in time, and in the next 2-3 months, I think could be a time where we would like to actually increase our weightage in the banking and financial services sector. Because if the economy is coming back and if the markets have to go higher, I think this is a sector again which would have to come back. If the markets have to really scale new heights in the coming quarters.
Mahesh, good to have you on the show. Thank you so much for taking the time out and speaking with us and giving us a color on how the market as well has been of late.